Hello and welcome back to the PPW pod, bringing you news, views, and interviews from the real estate marketplace and prop tech industry. I'll be your host today. I'm Harvey Hancock. As always, I'm joined by the incorrigible Simon Baker. Simon, how are you doing? Where are you today? Where are you logging in from? And what are you up to?
Okay, the Caribbean, St. Bart's, and I've said, and all is good, because how could it not be?
Good, brilliant. And today's guest, Malcolm Myers. Everyone recognises him from the Property Portal Watch conference. Malcolm, your first time on the show. Pleasure to have you.
Thank you. Pleasure to be here.
We'll get straight into it. Malcolm, you were the head of mergers and acquisitions at Naspers from 2007, 2009. 2010, you decided to go it alone. You founded European Internet Ventures. Since then, you've been helping marketplace businesses raise money and helping PE firms find investment opportunities. Let's go back to the start. How did you find your way into the marketplace industry and how have things changed over the last 15, 20 years?
So it started, as you said, with Naspers. I think in 2007, nobody had heard of Naspers. They thought I was working for Napster. We put them on the map very quickly. Well, they put themselves on the map very quickly by buying a company called QXL Ricardo PLC, which is actually the old-fashioned name for the business which everyone now knows as Allegro Group, which is a multi-billion-dollar private equity acquisition some years later. And I had the fun and the task of buying basically any marketplace that looked attractive and with a strong position, both in Europe and Southeast Asia, and also looking at LATAM.
I mean, how many companies was that during your time?
I bought 13 different businesses in a couple of years, and then they decided to become a regionalized business, and I moved on and started my advisory business. And my first client was Scout Group before the Hellman and Friedman acquisition.
Okay, actually, before we jump into sort of some views on the industry, 13 companies in 24 months.
Yeah.
What are some of the lessons you learned out of that? Because a lot of the people I come across and work with are looking at acquisitions, but maybe one or two in a 12-month period. So 6 or 7 in a 12-month period is quite amazing. What are the lessons learned, so the challenges that you came across, and how'd you get over them?
I mean, you need to know what you're looking for. So I think having very rigorous criteria for what works and what doesn't. And at those days, it was very much volumetric based, right? It was earlier stage businesses looking at high share of traffic, high share of supply, because these were all very much listings driven businesses. And also a belief that many markets, which today might be countries with 20 or 40 million people, could in the future generate businesses worth hundreds or even thousands of millions of euros.
Okay, and when you go through, actually a good question. You acquired 13 businesses back 15 years ago now.
Yep.
And if you were to look back, how many of them would you say were good acquisitions? How many would you say didn't really end up hitting the business case?
I would say it's roughly 50-50, which I think is actually better than you would expect. That often data shows that less than a quarter of all M&A really adds value. But here everything was right. The sector was right. The countries were right, and the timing was perfect because I was buying with cash during the global financial crisis.
So you're able to buy at a cheap price.
At a good price, although some of the best entrepreneurs, one of my favorite deals was for a small real estate portal where the guys weren't prepared to sell us everything based upon current multiples. So they agreed to hand over the control of the company without any cash passing hands. And then we were to remunerate them based upon the size of company they built 2 years down the road. It worked out well for both sides.
Okay. And so are you able to give out any of the names of the ones that worked?
I mean, the most obvious one is the set of businesses which is now called the Baltic Classifieds Group. So I bought, that was actually the very first deal. It was already running a little bit when I joined. And that business was sold for roughly 6 times what we paid for it in around 2014. And then now we know the same company is now a £1 billion plus quoted business. So this is a business that's gone from, let's say, 30 million to more than 30 times that in value in the space of roughly 12, 13 years until it was IPO'd.
Yeah. Excellent outcome. Sorry, Harvey, back to you.
Yeah, absolutely. I mean, I was going to move on to this a bit later, but while we're talking about merger and acquisitions, let's just go straight into it. CoStar Group, they buy on the market last year. Rumors that they might be sniffing around Idealista as well in Spain. I mean, Malcolm, you're probably the global expert on this. Are we going to see more portal operators doing what CoStar Group are doing right now? Will it even work? And where do you see that group going if indeed that is what their strategy is for the next 5-10 years?
So look, I have the greatest respect for CoStar. I think I also like the way they're putting a little bit of heat on what might have been slightly staid markets in some countries. That said, I think that the underlying network effects which we have in European and many of the top European businesses will make it very difficult to really shake things up. And remember, in the US, you've got MLS, which means that there's no real supply advantage. Whereas in Europe, clearly having the most supply is one of the things which drives traffic to your portals. So I think you've asked quite a few questions in one sentence. The first question is, yes, I think CoStar is interested. Yes, I think they can add a lot of value. If you look at the quantity of information they've packed into listings on homes.com, really impressive. And that obviously adds a lot of value to home seekers in particular. But I think dislodging the network effects which are driven by buy-side traffic as much as anything else on a company the size of Rightmove through propping up what's been a laggard for many years in the form of on the market is not for the faint-hearted. And it's something which I think CoStar will be disciplined about. They won't just pour endless amounts of money if they're not getting a return in terms of growing traffic, higher price points, and so on.
Okay, so
I'm going to jump in.
Sorry, Harvey. One second.
Could I jump in? Okay, go on, Simon.
Sorry, Harvey. When Andy Florence was talking at the PPW conference in Madrid, one of the things he said is he wants to buy these number 2 or number 3 players, and he has this innate belief that he can grow them to be number 1. I'm not sure how much you've paid attention to on the market in the UK, but do you think he's moved the needle at all?
Nope.
With what they're doing?
I mean, we know, Rightmove is at 85% of all traffic, all eyeballs, all minutes spent on in-market property in the UK. And I think on the market might be 3 to 5% of the 100, with Zoopla accounting for most of the difference. So I think the obvious thing to say is that until we see Rightmove's traffic going down, or until we see in the US, because in the US this competitive approach has been in play for longer, until we see Zillow starting to lose traffic in a big way, the jury is very much out on whether it is possible through heavy marketing spend and maybe some product refinements as well to really challenge the greatest network effects that we've seen in marketplaces, basically in any sector, right? That's what we're talking about.
Yep. So if you were to place a bet in 24 months' time,
yeah,
do you think there would be on the market still number 3 or maybe number 2? Or do you think CoStar may have acquired Zoopla because it's realized that you can't grow your way out of a hole? You've got to actually find some more dirt to put into it.
So I can see 2 scenarios. One is simply that Zoopla has lost their relative share compared to on the market, and maybe that would then be the moment for CoStar to make an offer to Silver Lake, who may be getting a little tired of having this asset for so long. That said, the Zoopla people are also working very hard on enhancing the product experience. They're not just sitting on their hands, right? They also have a clear product-led strategy to enhance differentiation against on the market, to tap into new revenue streams. But as we look today, Zoopla has been very flat in terms of core agency revenues. So there's clearly a need for them to change. If they don't succeed in changing, then I think they look very much like they're going to be for sale.
Okay. And I guess the challenge there is that Silver Lake spent, was it £2 billion, two and a bit billion?
More or less.
Yeah.
Okay. And would you argue Zoopla is worth that today?
Not in the financials which I have seen, but there may be something I'm missing.
Okay.
We'll
take that as
on this.
No.
One more question on this subject before we move on. This is sort of a pet peeve of mine. When I spoke to Andy Florence, on the record but off stage, he said there's a game of musical chairs that's going on in Europe, and I asked him who's starting the music, right? And he didn't give me an answer, and I think it's because he's the one who believes he's in control of the music. And I think what he said about wanting to become the number one players in all these countries is sort of a bit of PR puff piece. He doesn't want to say, I'm going to buy and then just stay where I am. I'm just wondering, is there not an angle to CoStar entering the European market across multiple, domestic markets, Spain, UK, France, just to have a piece of the pie, and not necessarily to push all the way for market leadership, but just to, have a seat at the table, so to speak?
Look, I think that viewed from the other side of the Atlantic, you have this a view that Europe looks fragmented. It's lots of small national markets. It must be possible to add lots of efficiency and treat this market in a more holistic manner. But in many respects, that's what Aviv has been trying to do since Eight's been running it for, 3 years. They've been trying to put some national champions on one consistent platform, right? Through some very, very ambitious IT work. And my understanding is that project is largely complete. But the interesting question is always, how much value are you then creating? And can you really buy these assets, at a price that gives you that very nice upside once you then try and run them? So I think it is difficult. I think the most obvious asset for CoStar to buy is probably Aviv. But KKR won't sell it, for a song. They will run a very competitive process. There will be other private equity, presumably also interested in that process. So I think the challenge will be getting some of these, getting number one assets or close to number one assets at a price that CoStar is comfortable paying for. That's going to be really, really interesting to see whether we find that those valuations get to where Andy is comfortable pulling the trigger.
Yep. Now, just actually a question on Aviv. Do you think that trying to put all these marketplaces on a single platform is actually worth the effort?
I mean, we will only know some years down the road, and we'll only know if we see services being launched which appeal to users across that footprint. And that might sound like a bland answer, but there's a lot behind it. So, for example, with Aviv's competitor in Germany, ImmoScout or Immobilien Scout, has built up over 100 million in revenues from consumer products, including these famous tenants subscriptions. That's a product that can only work in markets where you have relatively high rentals and low property ownership, right? So it's just one example where across the footprint, because Aviv is obviously present in Germany as their competitor, as well as in France, for example, it's just more difficult to come up with products that will resonate and be relevant across these different market footprints.
Yeah, I had the view that two things. One is the markets there's enough differences in the markets that it doesn't really warrant the investment in trying to build one-size-fits-all technology.
Yeah,
it's my first thought. And then my second thought is, if you're Aviv and I come along and say, I want to buy your ImmoWeb asset, but just that one.
Yeah.
Okay, and I'm going to offer you a big amount of money. And then you've got to say, well, how do I technologically spin that out? Okay, you're sort of putting everything together. And we face this issue with the Matilda Group, actually, where we had some potential opportunities to think about spinning out just part of the world But think of like LATAM, for example. And the problem was it was one platform. So you end up with all these technological issues of spinning out some countries based on a single platform. So I think there is a fundamental challenge about two. One is one size fits all. And I don't think in this game it does. And then the second is if you ever want to divest in the future, you may actually create more of a problem in this process.
You might do. I think there are ways of copying and creating instances of core platforms, but then you're losing a lot of your cost efficiencies, which were driving the high EBITDA in the first place. So I agree it's difficult. And, the best example of one size fits all failing is Lamudi, of course, the ambition to build 30 plus real estate portals in multiple emerging markets of one core stack run out of Berlin. And, I love the ambition, but clearly the execution proved somewhat difficult.
Yeah, and for those who don't know that story, do you want to just sort of recap how much they invested? Because it was a lot. Rocket invested a lot in that one.
I'm not sure I have the number. I'm guessing it's I don't know, 100 million euros, something like that.
Far more than that. And they had, as you said, sites across everything. And in reality, most of it got closed down and the last bits of it have just been sold off. One is Philippines and Indonesia to the Digital Classifieds Group based out of Australia. And the other one was Mexico to Lifel, maybe 18 months ago or something. I don't quite remember, 12, 18 months ago.
Exactly.
In that process. So you create all these platforms, most get closed down because there is no value. And the other thing that Lamudi forgot is that you're in 30 different countries. You need 30 different sales teams and 30 different headaches. And you're trying to control the whole lot from Berlin, which is not one of the 30 countries.
Exactly. And then you have the other issue that the monetization model, which has worked so well in Europe, subscriptions for agents who can afford to pay them, doesn't apply in many, many of these markets where you have a much more informal agency basis. Just something as simple as core monetization models clearly need to be adapted to fit local conditions.
Actually, that leads on to an interesting question. I mean, you've presented at the conference for, 10, 12 years or anyway, a long period of time. Over the last decade, what do you see as the two or three major real changes that have occurred? There's been a lot of noise. A lot of stuff has come and gone. Yeah. iBuying, for example. But what have been the real fundamental changes to the industry that you've seen?
I mean, my favorite presentation in recent years is the one where I show how little has changed, because I think the fundamental models have stayed very solid until now, right? So there's a long catalog of challenges, right? Which everything from Google to Facebook Marketplace to iBuyer, and none of these have really shaken the property portals which have been in number one positions thanks to strong network effects. So I think the interesting stuff is ahead of us rather than behind us. And as you know, as we've spoken and discussed, I think that superior matching driven by, call it AI, but a combination of data, machine learning, and some AI will fundamentally change the monetization models of portals. I think we're going to have to move more to a transaction-based, or at least action-based forms of remuneration. I think that will cause a lot of change. But it's hard to say that a lot has changed in the past looking backwards.
Okay.
I mean, Malcolm, I'll jump in there and go and bring us back on track to one of the topics I wanted to mention, which was, you mentioned it, those two important letters, AI. When we spoke at the Bangkok conference on the podcast, Simon said, I'm going to put my neck out there and say that this could be the catalyst for seismic change in the industry. What's your response to Simon's position? And then, I'd invite you to open up the discussion with your own personal view on how things may go in terms of artificial intelligence and how we integrate it in the coming years.
So look, it is inevitable. AI will change the property portal experience. I think the interesting question is, does it undermine the fundamentals of the property portal? And that is an area where I think there is a degree of momentum in the current models, which AI is more likely to enhance than to undermine if we take a 3 to 5 year view. I think going further out, it's more complex. And we're already seeing things, right? We're already seeing more intuitive search, the ability to put in text words like you would, a text query like you would on ChatGPT, and not have to say, it's London Northwest 3 where I'm looking at. And the ability to get better suggestions, better proposals, better examples of other properties which are like the ones you're looking for. Or think about the whole recommendation engine coming up with homes where you get trade-offs. If you move another 5 kilometers further out or get a 20-minute longer commute, you can have twice the space for the same price. So I think just getting more sophistication or more insight into what's really available is one of the most interesting things that's going to happen. And guess what? That's good for portals. Why? Because it means they can drive more leads to some of the less obvious properties, and thus, in my view, monetize the less obvious properties more effectively than they are able to today.
Okay. I think one of the interesting opportunities here is it's not only how AI can impact the portal industry, but also how it can impact the real estate industry as a whole. Because if you think about where the industry tends to fall over, lead management is the most obvious one. A lot of calls come in, don't get answered, or are poorly answered. And if you're not really there to buy a property in 30 seconds, you're probably not getting a lot of love. So lead management, lead nurturing is not done well. Marketing is often not done very well. It's usually, I'll just do it. I'll put in the hands of the portals and I'll get my leads, and everything's easy, and I can go back to the person who's selling the house and say, I've done my job, which is often what they're looking to do in that process. And I think AI has the capacity to really smooth those parts of the process, those actions. Because I think one of the things you said before, Malcolm, which was interesting, is getting paid for action rather than just paid for advertising, which sometimes is inaction. It's very passive in its approach. So I think there's a chance for AI to really impact how the industry works, as well as how the portal. So the real estate industry works, as well as how the portal advertising industry works, and potentially there's a chance for those two to truly come together far more, as we're starting to see in third world countries. That's a horrible thing to say. Not third world countries, say emerging markets, ones where there's not a clearly defined industry, and where making money as a portal is very challenging. And we're starting to see transaction-driven businesses do very well. I mean, Zameen is a good example of one of them. So why can't that then follow through to the more established markets? And that's probably an open question. Can you see that type model because of AI?
So I think AI is actually in the short term, it's the agent's greatest friend. Agencies will become better at answering those queries, better at following up on those leads as a result of a lot of the tools which they will be getting. And things as simple as generative AI to help write much better property markups, right? Much better listings. These can, and also make much better recommendations to buyers, right? So I think ironically, the agent in the short term will become more empowered and more efficient. But in the medium term, and this was since I've been presenting, I think it's since 2019, I've raised the idea of, do we really need the agent to sell some ultra standardized new build properties which are off plan? Could a portal do that with the help of a back office, let's call it an inside sales team, which is not as remunerated nearly as lavishly as real estate agents are? So I think there are plenty of forces which will, in the medium term, put more pressure on agents when we can find perhaps almost as much value add, or potentially more value add, coming from a more automated setup.
Yep. The other thing where I think it does pose a risk to a portal is providing the agency with intelligence around where to market each listing and what's the right blend of marketing. So some listings will be absolutely suited for Facebook and, I don't know, Instagram because of first home buyers or whatever. Other listings are going to be far more suited to a traditional model. Then it's just about the weighting of how you spend. Maybe instead of buying the super feature property on the portal, I'll take that extra money and spend it on Facebook, or I'll spend it on Instagram, or I'll spend it on some other channel to get a better return. And now only AI can really see all that, because the agents won't track it. For sure, they won't track the true efficacy of each channel by property type. It's just not going to happen. But AI has the capacity to bring that data together to say, this property market on this channel with this weighting of expenditure.
I think that's very true, but I think you'll find that the portals will use the sort of the tricks of the music publishers in the sort of in the former era. Well, they'll put the sort of the B tracks together with the A tracks. So the same idea is the subscription. You'll have to subscribe to for everything, even if you actually only want, or you have to buy a certain minimum number of premium listings, even if your current portfolio of properties probably only needs one or two. That's how I suspect they will respond in the short term, at least.
Yes, but we know what happened to music publishers.
Yep.
Do you still get a B-side?
Sorry?
Yeah.
Yep.
You eventually you can go down, you'll end up still getting. So I think there's a little bit of the tidal wave is coming. I'm going to try to hold back what is happening. No different to what the newspapers did, to be honest.
Yeah, but having said that, I think, Simon, we should also be fair. A lot of the leading portals are being very proactive in using technology to build additional revenue streams and become thus less reliant on the core advertising. If you look at how Rightmove is trying to digitize the rentals experience, both Scout and Rightmove are trying to build closing style services. So although you have to still go offline and to look at a property, right? Most people want to visit them physically. You can then go back online for a lot of the negotiation and closing processes. And I think these kinds of activities will both generate more revenues and also probably further entrench those network effects. If you build the glue which more and more agencies like to use to service their customers, I think that helps to entrench their positions.
I think what is driving that is these revolutionary waves. So print to online and AI, the two I see. I think everything else has been sort of little ripples in the in between. Is that the people who are encountering this AI wave also have memory of the print to digital wave. So it's not like you're talking to a bunch of grey-haired old people who have never been disrupted. They have been the disruptor, now potentially could be disrupted. So they are innovating to maintain their relevance.
I think that's right. And I think, again, the volume, one reason, going back to the CoStar question, one reason why Rightmove is so strong is just, 20 years, not just of static data, but what I call dynamic data. So how each user is interacting with the platform, how, what they're clicking on and what they're not clicking on. And this kind of data, if you have the right, data science, data structure, AI behind it, compounds the advantage you have from your scale. So I think the clear message is, if you don't adapt, your lead may start to be narrowed away. But if you embrace the advantages you have as a number one and double down on data, then you have every chance. And, Scout's about 100 million euros on product and tech. Rightmove has hired over 100 people. This is revolutionary. Rightmove doesn't usually hire anyone, right? Because they've been having these amazingly high EBITDA margins, and then under new leadership, they've hired more than 100 people, many of whom I assume are product and tech, precisely so they can build these additional services and compound the advantages they have as the leader.
Yes, although probably for Rightmove 100, it's not that many.
True.
What do you think? I mean, how many were there before? There probably weren't that many before, so I can understand why.
Maybe 700, and their EBITDA margins are actually going down 2 or 3 points as a result of this. But of course, the assumption is
2 or 3 points down from what, 75 to 72.
Yeah, down from
74 down to 71.
They must be crying themselves to sleep.
Okay, 74 to 71. Okay, well, my heart's bleeding at this point in time. So I guess that is the Andy Florence effect. we'll call it.
Indeed.
The butterfly flapping its wings in the US, and Rightmove is employing people in England. Okay, understand.
Malcolm, let's talk about what you're doing in your business at the moment. So, European Internet Ventures, you're doing M&As, you're helping people find capital, find exits. We were talking about this a bit off camera before we started recording, but can you give us a sense of the time it takes to complete these processes, and particularly for our listeners, especially for those in the next generation of business leaders, shall we say, listening to the podcast? What kind of highlights and takeaways can you give them for people trying to approach these processes, finding capital, finding an exit for the first time? And then obviously, Simon, I would invite you to share your experiences afterwards.
Terrific. So remember, European Interventions only really gets involved at what I call a Series B or a large Series A. So when it's time to raise, 15 or 20 million. And at that stage, companies tend to have a good track record. They tend to have good data on growth and hopefully some profitability, or at least very good unit economics. And I think when you have at that stage, you should still expect to take 6 to 12 months to get around completed. And that doesn't mean to say that you're talking to the same investors for 6 to 12 months. It means that you need to spend a lot of time preparing your story, making sure that your metrics are looking as they should, so that they get past the initial filters, which a lot of growth stage investors will have. But so I think, and clearly that velocity has slowed down. I think in 2021 there was one deal I worked on where the same day of the first investor presentation, by the evening we had a term sheet, and that deal was closed 6-7 weeks after that. So it can be crazy short, but you should obviously be banking on it taking rather longer.
I mean, what circumstances need to be filled for somebody to get a term sheet done at the end of one day? I mean, is this a once in a blue moon kind of business, or is this just a very well prepared business who really did
it's
their
a really
due diligence?
It's a really good question. Of course, I'll take some of the credit that the materials have to be very well so that they answer all, because if you've been doing this for 15 years, you know what questions investors have, right? And you know what they want to see. So of course you prepare the material as well. The other reason is because you know which investors really like this kind of company, right? So it so happened that this was a serial marketplace investor, and they just felt comfortable with what they were seeing. So it's really, I would say, preparation and investor fit are probably two of the best drivers of getting that closing window down to a reasonable period of time.
Simon?
Yes, that is definitely at the rare end of the scale. And I'm working with someone at the moment, just helping them raise about $4 million, and it's not a quick process, because you've got to find the right investors to talk to. Okay, you've got to be matching their ticket size, you've got to be matching their current capacity to invest, you've got to be matching if it's a fund, how long before they've got to make how long that fund's got to run, because you need the oxygen, you don't want to have a pressure down the track. You've also got to make sure they understand the industry, okay, and they've got a passion for it, and so on. So there's a lot of boxes you've got to tick, and depending in where you are in the world, if you're in the middle of the US, there are like 1 million of each boxes, right, of funds in each box. There's just so many of them. But if you're in Latin America, it goes to a very, very small group that you have to target. And if you are not very clear on your message and very targeted with those meetings, you'll go nowhere.
I would add, Harvey, sorry, Tom. I would add, Harvey, I think it's one of the aspects of fundraising which most founders underestimate. It's how tightly the mandates of different investors are defined. And as Simon was saying, it's everything from geography to stage to business model, and it's when you eliminate all the ones which fall out on those grounds, you have to be really compelling with the ones which do fit the exact criteria.
Yes.
I mean, one of the things we were talking about off camera again was due diligence and
Yep.
and maybe businesses not understanding what great due diligence looks like. Could you just go into a little bit more detail about the context of that situation?
Look, I think capital raising due diligence tends to be a little lighter than when you're doing a sale process, right? So I think on capital raising, the most often trip up is ownership of IP. But when you're doing a full scale M&A, then you have to be extremely clear that you understand all the issues that the company has had in the past, and even the best run companies, there will always be things. They'll be unhappy. There'll be litigation. There'll be people who've written letters saying that they're going to sue them, and things like this. And you just have to be very good at getting all the all the cobwebs out at the beginning of the process, and so you can be very open and clear to potential buyers about what there is. And sometimes I would actually do all that even at the term sheet level, so that investors don't then, or buyers don't then have an argument to try and reduce the price afterwards. Sometimes at the term sheet level, you tend to have a number of different potential interested parties, and that's usually the best time to open up and be clear about any issues which could potentially have an impact upon valuation.
Simon, I mean, you've invested in companies. Have you ever been surprised by the cobwebs that have been hidden, deliberately or otherwise, by businesses? I mean,
Yes.
Are you
You're
allowed to
always
give us any war
surprised.
stories?
Well,
Yeah,
you're always. It's a case of you know that no one's ever going to tell you everything, right? They never do, right? Because if you're going to invest in a business or buy a business, they want to put on the best possible face to get the best possible value, and they want to hand on to you any problems they may have. Okay, that's just the fact of life, and it comes when you're selling a business too. I mean, we've sold a business about 4 years ago, and we're still waiting for the final payment because money has been withheld in escrow due to a legal case that has taken forever. And then that same business, then the government decided to have a look at it to see if the capital gains tax calculation was correct. Everyone sees an opportunity when you buy and sell businesses to put their fingers in the pie. But I think one of the funniest stories that I've had as an investor, and I've invested in, I don't know, 50 plus companies over 15 years. And this is one of the things where you try to do your due diligence on both the company and the individuals around it, but I clearly didn't do this one well enough. So I invested in a company, definitely not going to say who the company was or definitely who the individual was, but it had a strong, charismatic CEO, founder. And so a group of us invested some money into the business, took a meaningful stake. And then we had a meeting about 6 months, maybe 9 months later, and we're sort of going through the numbers, and the guys run out of cash. I'm going, what do you mean you're running out of cash? Okay. And then I said, give me the balance sheet. So that's when you start digging deep. And I noticed on there the purchase of a Tesla. So I've gone, why do we own a Tesla? Well, in my market, as a director, chair, CEO of the business, it's expected that the company gives you a car. I'm going, yeah, get a friggin' VW Beetle. Don't get a, in
top of the
those days,
range.
€150,000 Tesla or whatever the price was. And I realized looking back that we owned a third of that vehicle. Okay. Right now, but we didn't get to drive it a third of the time.
No.
So that's when you've got to be careful, not only putting money in, but also on what people do with the money. And that's a fun little side story, but actually a real story, which fortunately we were able to buy our equity back for about 80 cents in the dollar, and then we just kept running.
Congratulations, Malcolm.
For the
Any
hills.
war stories?
But it did take quite a few letters from a lawyer. around misappropriation of funds and a whole range of stuff that to scare the founder into to honestly doing the right thing. It's like, well, what else have you done? We then wanted to go into what else you've done with the money. Are you paying yourself? And there was a lot of business class trips and things that just did not make sense. And actually, there's an interesting sidelight to that. When I look back over the from an investor perspective into companies, is you've got to make yourself a very attractive investee. Okay, and one of the tests that I like to do is the beer test, is where you can actually go out and have a real beer with someone. And I don't mean like have a beer, but I mean have a real conversation over a beer. So you can cut through all the bullshit, cut through all the noise, and have a real conversation about what's working, what's not working in the business. Because when the proverbial hits the fan, you've got to be able to sit down as both shareholders and management and have real conversations about what's working, what's not working. And when I look at the investments that have failed, I wouldn't want to have a beer with the guys in hindsight. All right. So that is a very important test, I think, in as an investor. Anyway, slight digression, but ways to think about this.
Malcolm, do you go with beers for the people coming to you, or
I will.
What are the red flags that you've spotted in the past, perhaps?
I will say that I spend much more time. So my business model is success fee only. So you have to be extremely sure that for capital raising and sell side. So you have to be extremely sure that you have seen the company in its true light. So I think the biggest change is I now spend 3 or 4 weeks doing due diligence on potential clients, and I would say, touching wood, most of the stuff has come out. I think my biggest, most frequently committed mistake is I get overly excited and enthusiastic about potential clients' businesses, perhaps because I love the sector so much and I've seen so many success stories in it. And sometimes I forget quite how difficult it can be to convince purely financial investors who can choose, between 50 different business categories to invest in, to share with them the excitement of why this is a great marketplace. So that's more what I'm focusing on. But clearly, personality of the founders is fundamental. And if they don't energize the Zoom call, at least if it's not a beer, then it's unlikely that you're going to get all the way across to the finishing line.
Yep. And my worst, apart from the guy who likes to buy a Tesla, or doesn't, you can't really have an interaction with them. It's the founder / CEO who knows it all, like absolutely everything, and you get them. And the problem with that is you put them in front of an investor who, A, is going to want to test the knowledge, understanding, and the opportunity, but B, probably wants to contribute somehow. And when they're just getting someone saying, no, I know what I'm doing, just give me money and piss off, right? Which is not exactly those words, but that's
the message.
That's the message that they're giving. Makes it really hard, okay? Because no one knows everything, and everyone can benefit from input into how to grow the business. If it's not for just knowledge on how to build a product, but maybe it's relationships on how to grow your market, or even and one of the conversation I was having last week was building relationships with people who can help exit the business in 3 to 4 years' time. You've always got to be thinking a long way ahead as an investor going in to this.
And talking of exit, when I help, one of the things I do is I train management teams to prepare them right for those management discussions with potential buyers. And one of the most common tendencies they have is they always, picking up on Simon's last one, they always want to have an answer. So why didn't you do X? Why didn't you do Y? And the best advice you can possibly give them is now and then say, yes, buyer, that's a brilliant idea. I'm sure if we were to do that now, it could generate some additional value.
Please invest to give us the oxygen.
Exactly.
I mean, but it is true though. I mean, you meet them in every walk of life, and the people who think they could do it all alone, and humility goes such a long way, right? And I guess, are there any other sort of positive personality traits that both of you would sort of agree on as being sort of nice to haves when you have people approaching you for the first time? Do you sometimes get a feeling that, you know, this guy could be the one I'm going to invest in the future?
It's funny, the criteria which you most need to get through a funding round is resilience. And it's probably one of the harder things to test for when you're making up your mind whether to work with someone, because you really only find out if people are resilient if you're with them for, you know, many, many months. But I think that's what amazes me. You know, sometimes funding clients which started in, you know, the second half of 2022, you know, took more than 6 months, right, to get things sorted out, and just seeing the perpetual, you know, this perfect blend between learning from what hasn't happened perfectly, but also having this perpetual optimism in the business and in its ability to actually get to the next level when investors do want to invest. I think that's really the secret sauce to try and find in a client.
Yeah, I agree with that.
One final question, Malcolm. I like to ask this to everyone I interview: is something that the industry isn't talking about that you wish that they maybe spent more time talking about?
Oh, that's tricky. As you know, I work in a lot of different verticals, a lot of car and an awful lot of recruitment. And I think the interesting question is, one, I think that if you're if you're a number one property portal, you've got your life relatively easy compared to being in cars, and especially compared to being in jobs where there's far fewer barriers to entry. So I think the first point to make is, you know, acknowledge that actually you're in a very privileged position. The other thing, which does peeve me somewhat, is the lack of attention that some of the second-tier countries have had in their property portals. So I think, you know, there are regions of the world which do support subscription businesses, but because they're not in Europe or not in the US, it's much harder to find investors in or buyers for. So I think that's another takeaway. I would say, you know, the ability to create, it may not be a Rightmove or a Hemnet, but something which has, you know, 20, 30, 40% of the potential, that's still a very attractive business to have, especially if you're not, you know, investing more than 20, 30, 40 million to get that.
Absolutely. Well, I think that's a great spot to wrap up, everyone. Malcolm, it's been a pleasure speaking to you. Great to have you on the pod and have a nice long conversation. Pleasure to have you, and looking forward to seeing you back on the show again soon, eh?
Thank you, Harvey. It was a pleasure.
Okay, thanks, Malcolm. Great to see you again, and we'll see you in Barcelona in October.
Oh, big news.
No,
We'll leave it on that.
Big news for anyone who bothered staying to the end. PPW conference in Europe, in Barcelona, in October, beginning of the month. Information being launched shortly.
There you have it, guys. Breaking news. Right. Until next time. Bye-bye.
Thanks. Bye-bye.